Welcome to the Deep Dive. Today, we're tackling something a bit tricky in finance. Stop-loss rules.
Right. Those rules where you sell if a price drops by, say, 10%.
Exactly. Aiming to cut your losses. Now, you talk to traders, investors. A lot of them use these. They see it as basic risk management.
Standard practice for many.
But then you look at, well, traditional academic finance, and there's a lot of skepticism there.
A fair bit, yeah. Especially from the efficient market folks.
So we've got this research paper that looks right into this gap. And our job today is to figure out, based on this paper, when these rules might actually make sense and maybe why.
Okay. So the skepticism, where does that usually start?
Well, often it goes back to the random walk hypothesis, right?
The idea that prices move randomly, like flipping a coin.
Yeah, unpredictable. So the past drop that triggers your stop loss, it tells you nothing about the future.
Exactly. And if that's true, this paper confirms using a stop loss always hurts your expected return. Theoretically, yes. Under a pure random walk, you're just forcing a sale after a dip, locking in the loss.
Going low, basically,
Yeah.
based on noise, and you might miss the rebound.
Precisely. That's the standard theoretical argument against them.
Okay, so theory says no, but, the world isn't always pure theory. What does this paper find that challenges that?
Well, this is where it gets interesting. The paper's core idea is that stop losses can actually add value, but, and this is the key, only if returns don't behave like a perfect random walk.
Okay, so if there are patterns, like what?
Like momentum, where losses tend to be followed by more losses for a while, or maybe regime switching, periods where returns are just generally low.
So if the market isn't just random coin flips after a drop.
Right. In those cases, the paper suggests getting out via a stop loss could actually be smart. It's not just noise anymore. It might be a signal.
And they tested this with real data.
They did. They looked at monthly U.S. stocks and long-term government bonds from 1950 to 2004, a pretty long stretch of history.
And the results, were they surprising?
I'd say so, yeah. Especially if you're firmly in the never sell after a loss camp.
What did they find?
Okay, so applying some simple stop-loss rules, like, say, sell equities and move into bonds if equities drop X%. They found it did two main things. First, it significantly reduced the portfolio's overall volatility, smoothed out the ride.
Okay, lower risk. That makes some sense. But what about returns?
That's the kicker. They found what they call a positive stopping premium.
Meaning?
Meaning, during the specific times the portfolio was starved out of equities and sitting in bonds, the average return was actually higher than it would have been just staying in equities.
Wait, selling after a loss led to higher returns during those periods and lower risk.
That's what this historical data showed for the rules they tested. Yeah, it really goes against the grain.
How much higher? Was it significant?
It was noticeable, around 50 to 100 basis points per month, on average, during those stop-out periods.
Wow, okay. 0.5% to 1% per month extra return, just for being out.
During those specific times, yes. And interestingly, the bonds themselves, they tended to perform really well precisely during those periods when the equity stop losses were triggered.
Okay, so there's a pattern here. Equities drop, trigger stop loss, move to bonds, and historically, bonds did well then. Why? What's the paper's explanation for this? It can't just be luck over 50 years.
Well, they propose a potential link to behavioral finance, a kind of regime switching model driven by investor psychology.
You mean like when stocks crash, people panic and rush into safer assets?
Sort of, yeah. The idea is maybe like a flight to safety. Big equity losses trigger a shift in behavior across the market.
Okay.
People get scared. Maybe they collectively move towards safer things like government bonds, pushing their prices up.
So the stop loss rule, by mechanically moving you into bonds after a big equity drop.
It might just be accidentally aligning you with that behavioral shift. You get out of stocks just as the crowd is potentially causing bonds to outperform.
So the rule isn't predicting the future perfectly, but it's maybe reacting systematically to a behavioral pattern in the market.
That's the hypothesis they put forward. It suggests the market, especially after big losses, isn't always efficiently random. Behavior matters.
So pulling this all together, what's the takeaway for you, the listener, thinking about stop losses?
Well, it seems they're not universally bad or useless, despite some theories. This research, looking at actual history, suggests that under certain conditions
Conditions may be linked to momentum or these behavioral shifts.
Exactly. Under those conditions, they can potentially add value, maybe increase returns during bad times and definitely reduce risk. They might capture market dynamics that simple random walk models just miss.
Right. So maybe think about why you're using them and what market behavior they might be tapping into.
And here's a final thought this paper leaves us with. Could it be that big market drops, those times of cumulative loss, actually do create temporary pockets of predictability? Not because of fundamentals changing overnight, but because of how we, as investors, react collectively. Maybe that panic isn't just noise, but a force that briefly changes the game. Something to think about.